All right. So a few of the key assumptions of an audit are that, management is responsible for all of the assertions that are being audited. From an audit standpoint, we're looking for reasonable assurance. No internal control system can be perfect. As we've discussed, that would be cost prohibitive. So we want to make sure that it is reasonable. The cost benefit analysis has been done appropriately and that their control system meets those goals. The audit objectives remain the same regardless of what kind of data processing the company has. You can think back to old completely paper-based systems from beginning to end to today's computerized systems that handle thousands, if not millions, of transactions a day. The objectives are the same. We're looking to assure the reasonableness of those financial statements, review the controls environment, and so forth. Now, those specific controls that are in place are going to vary based on the technologies in use, but our objectives remain the same. And we always have limitations. There are possibilities of errors that slip through. There are possibilities that controls can be circumvented by employees that are highly motivated. Management can override controls. And of course, changing business conditions change the valuations in particular of various items in the financial statements. So let's think about those controls. And when we have controls, we have a couple different things that we need to be concerned with. First is exposure. A company has an exposure when, in a business process, when there's an absence of or a very weak control in place in that business process. So that's exposure. We're lacking in control. We don't have a strong control. There are weaknesses that can be exploited. Next comes the risk. So the risk is, what is the threat of that exposure being exploited? What would be the result if that exposure is exploited? How much could we lose? What could happen to the business? And we've got lots of different types of risks. Assets could be destroyed or stolen. Information could be corrupted in the AIS. Processing could be disrupted as well. So you can think denial of service attacks. They're basically aimed at bringing a website down. And if that website is one of your front ends to the sales process, that means there's an interruption to your revenues. So from an audit perspective, we have what we call the audit risk formula. Now, in a financial statement audit, the end result is the auditor's opinion. In any other type of audit, the end result is the audit report. So in either case, our primary risk in the audit is that whatever we have in our opinion or whatever we have in the audit report is wrong. Our opinion is inappropriate. In particular, for a financial statement audit, we gave a clean opinion, but there are material misstatements. Now, there are such things as type 1 and type 2 error. You'll cover those in your audit courses, but in short, basically, it's the two different types of mistakes you can make. You can give a clean opinion when there are misstatements, or you can give a qualified opinion when in actuality there are no material misstatements. So the audit risk is made up of three components. First, we have the inherent risk. That's basically the probability that we have a material misstatement, period. And it could be related to changing economic conditions, the political climate that the company does business in. Certainly it's related to the nature of the asset that you're looking at. Cash sitting around in a big basket is very risky. Certain types of inventory that are small and easily transportable can be risky. large fixed equipment, maybe less risky. It's harder for someone to sneak out with that. So again, all kinds of things come into play when it comes to the inherent risk of various assets. Next, we have the control risk. This is the risk that the company's internal control processes will not catch or detect any kind of material misstatement. So inventory walks out the door, the company never figures it out. The company does not catch it, make an adjustment to their books, whatever. So the internal controls fail to detect misstatements. And then finally, there's the detection risk. And that's the probability that the audit procedures, these are those substantive procedures that the auditors perform during the busy season portion of the audit typically, will fail to detect material misstatements as well. And because audit risk is a function of those three, we can lay it out as a formula. And that formula looks like this: audit risk equals inherent risk times control risk times detection risk. And CPA firms tend to set the audit risk fairly low. Generally about 5% seems to be kind of an agreed on standard for the overall audit risk. So if we have a company with inherent risk of 40%, so we have taken a look at the particular account that we're dealing with, maybe it's inventory, and we have decided, well, based on the nature of this business, the rate of change maybe in technology, the transportability of these materials, they can disappear in the back of a pickup truck fairly easily. There's a 40% likelihood that the inventory valuation is off right now. Control risk, based on the controls in place at the company, when we review their internal control environment, we've decided or estimated that there's a 60% risk that their internal controls will fail to catch or detect these misstatements that result from the inherent risk. So if we want audit risk to equal 5%, well, we've got our formula there, and we can basically plug detection risk and figure out how to perform our audit. In this case, the audit detection risk ends up being around 21%. So why do we set audit risk at 5%? And what is that detection risk? How does that relate to the procedures that are performed during the audit? Is it realistic to expect management to be able to get the control risk down to zero? And what is the relationship between detection risk and the extensiveness of the substantive procedures that are performed in the audit? So, we took a look at that formula with a sample scenario, and those tests and controls relate to the substantive tests directly. As we review the tests of controls, basically the controls review generally performed during the fiscal year, that plays a large role in how we determine the extensiveness of the substantive tests that will be performed in the audit itself. So let's say we completed last year's audit, and we, as part of our audit, since we're providing value with our audit on top of the opinion, we gave management a number of recommendations to improve their internal control environment. And we see that this year they implemented a fair number of those, and we have determined that their internal control environment is more reliable than it was last year. So you remember last year we had a control risk of 0.6 or 60%, which led to our detection risk needing to be at around 21%. So let's say this year they have been able to improve their internal controls, and in our review we decide there's only a 40% risk now. 40% control risk. And that allows us to float the detection risk up a little bit more and allow it to float up to about 32%, which means we have to perform fewer substantive procedures, which are the labor-intensive procedures that are performed as part of the financial statement audit. And so then we have the option of providing additional value services as part of the audit. We have the option of reducing the cost of the audit or making it more profitable for us. So we have a little bit of flexibility there. Now, what can you say about the components in this model? Audit risk, inherent risk, control risk, detection risk. Well, one thing, despite the fact that we've got them all laid out in a nice mathematical formula here, it's important to remember that every number in this formula is an estimate. Now, it's not a wild estimate. That's where professional expertise comes into play, and the whole notion of the AICPA's definition of CPAs as a trusted business advisor come in. So we bring experience from previous audits, industry knowledge, and the like to bear in putting these estimates together.